Hello students, welcome to this video lecture series. In this video, we are going to see regarding the chapter Cash Flow Statement from Management Accounting. Now we are going to see regarding only the introduction part 1. Later on, we will be dealing with part 2 which consists of problems. Meaning of Cash Flow Statement. Cash flow statement is the statement which highlights the inflows and outflows of cash during a specific period. It explains the reasons for the change in cash position of a company. Transactions which increase the cash position of the company are called as inflow of cash, and those activities which decrease the cash position of the company will be called as outflow of cash. Cash flow statement traces the various sources from which the cash, such as cash from operation, sale of current and fixed asset, issue of share capital and debentures, etc., and applications which causes outflow of cash, such as loss from operations, purchase of current and fixed asset, redemption of debentures and preference shares, and other long-term debt for cash will be considered here. Preparation of cash flow statement. A cash flow statement can be prepared with the help of opening and closing balance sheets, profit and loss account, and other additional information given in the question. So, the net effect of such cash movement is known as net cash flow, which is added or deducted to the opening balance of cash or bank balance to get closing balance of cash or bank. Therefore, it becomes necessary to have a thorough knowledge of various items of cash inflow and cash outflow. Now we are going to see regarding items of cash inflow. So the first one is cash from operations or cash operating profit. Cash from trading operations during the year is very important source of cash inflows. The ultimate result of the business transaction would either be net profit or net loss. While net profit results in cash inflow, net loss will result in cash outflow. For considering inflow and outflow of cash from operations, the following changes in current assets and current liabilities are to be considered. So the first one is changes in book debts. It can be expressed like cash from operations is equal to net operating profit plus decrease in debtors and bills receivable or minus increase in debtors and bills receivable. Second one is changes in trade liabilities. It can be presented like cash from operations is equal to net operating profit plus increase in creditors and bills payable or minus decrease in creditors and bills payable. The third one is changes in income received in advance can be expressed as cash from operations is equal to net operating profit plus increase in income received in advance or minus decrease in income received in advance. Next one is changes in prepaid expenses can be expressed as cash from operations is equal to net operating profit plus decrease in prepaid expenses or minus increase in prepaid expenses. The next one is changes in accrued income can be expressed as cash from operations is equal to net operating profit plus decrease in accrued income or minus increase in accrued income. The next one is outstanding expenses can be expressed like cash from operation is equal to net operating profit plus increase in outstanding expenses or minus decrease in outstanding expenses. And the last one under cash from operations will be changes in stock can be expressed like cash from operations is equal to net operating profit plus decrease in stock or minus increase in stock. Apart from this, we are going to see increase in share capital and non-current liabilities. The increase in share capital, debentures, long-term loans, etc. is usually considered as inflow of cash. Next one is sale of fixed assets. The amount realized from the fixed assets, that is sale of fixed assets like land, buildings, or machinery, is to be considered as a source of cash. And the last one is non-trading receipts. Under this, some special circumstance, a business concern maybe get some non-trading receipts like dividend received, rent received, a refund of tax, etc. Such receipts or incomes, although non-trading in nature, result in inflow of cash. Items of outflows, that is application of cash. In previous slide we would have seen regarding sources of cash. Now we are going to see regarding application of cash. Under that we have four major items. First one is cash lost in operation, which means any trading loss arising as a result of business operations during the year become the application of cash, and it will be considered for as outflow for the business. Second one is redemption of redeemable preference shares and debentures. The amount paid for redemption of preference share capital or debentures or any other long-term loan should be considered as outflow of cash. The next one is purchase of fixed assets. Payment made for purchase of fixed assets like land, building, furniture, and machinery can be considered as uses of cash. The amount paid to accrued long-term investment also constitute as an application of cash. And the last item under application of cash will be non-trading payments. Sometimes there may be non-trading payments like payment of dividend, income tax, etc. Such payments or expenses are, although non-trading in nature, result in outflow of cash, and hence it should be considered as cash outflow in the cash outflow statement. Steps involved in preparation of cash flow statement. Under that we have four major steps. First one is preparation of non-current accounts. The first step in the preparation of non cash flow statement is ascertainment of hidden information about sources and uses of cash. In order to ascertain the various sources and uses of cash, analysis of changes in non-current account is essential. If no additional information is given for non-current accounts, the sources or uses of cash can be found out by comparing the current year's figure of concerned assets and liability account with previous year figure. In case any additional information is given for non-current accounts, it is necessary to open an account for each non-current assets and non-current liability to dig out the hidden information as a balancing figure. The following non-current accounts are usually prepared to ascertain hidden information like as done in fund flow statement like fixed asset account, accumulated depreciation account, investment account, and provision for taxation. These four accounts should be prepared as to find out the hidden information given from the question. The second step is calculation of funds from operation. This we would have seen in the last chapter. And the third one is calculation of cash from operations. After ascertaining net profit, that is funds from operations, and comparison of individual items of current assets as well as current liabilities are made and the changes are noted down. The decrease in current assets and increase in current liabilities are added to the net profit. An increase in current assets and decrease in current liabilities are subtracted from the net profit, net operating profit. The resulting figure after all these adjustments will represent cash from operation. And the last step is preparation of cash flow statement. The findings of all the above mentioned steps are to be incorporated in this statement. The statement starts with the cash and bank balance at the beginning of the period. If there is bank overdraft and cash balance, the net cash balance or net bank overdraft becomes the starting point. The various sources of cash are added to the opening balance and the uses of cash are subtracted. The balance represents the cash and bank balance at the end of the accounting period. We have two types of format for statement of cash flow statement. One is statement form, that is vertical method which you are seeing in the screen, and the second one is account form or T form or horizontal method which will be explained in the next slide. So here you can see they have given cash flow statement for the year ended. Particulars rupees, two columns we have, one is inner column and second one is outer column. Under that we have opening balance as we saw already, we have cash and bank balance. With that you have to add the sources of cash. So these are the various items of sources of cash which you have to find out, and then after adding all the sources of cash with cash and bank balance, you will be getting the total sources, and with that you will be writing the total cash available in the outer column. With that you will be deducting the application of cash, where all the items shown in the slide will be appear there, and you will be finding out the total application, and at last you will be writing closing balance, cash and bank balance, and you will be arriving the total. The next slide we will be seeing the account form or horizontal method. So this is the account form or T form which the cash flow statement will appear in horizontal method. Here you can see two particular columns and two amount column will be there. In the first column you will be getting all opening balance, cash and bank balance. With that you will be adding the cash inflow and you will be getting one total. In the next column you will be writing the cash outflow, and at last you will be showing the closing balance of cash and bank balance. You will get the you will the to, both the total column will be tallied. Now we are going to see regarding the revised accounting standard of cash flow statement. The ICAI has issued an accounting standard AS3 on the subject titled Cash Flow Statement in April 1997. This has been replaced the earlier AS3 on Statement of Changes in Financial Position. However, the standard has been made mandatory with effect from 1/4/2001 in respect of the following. AS3 revised requires that cash flow statement should be presented in the manner that highlights all the major categories of cash flow. AS3 revised has classified cash flow into three categories. They are as follows. As you see in the screen, we have cash flow from operating activities, and that we have net profit before tax and extraordinary items. With that you should add certain items like depreciation, preliminary discount, loss, goodwill written off, patent and trademark written off, loss on sale of fixed asset, interest on borrowings and debentures, etc. should be added. You will be getting one total. With it you should deduct certain items like interest income, dividend income, rental income, profit on sale of financial assets, etc. will be deducted. And after that you will be getting operating profit before working capital changes. Again with that you have to add the net decrease in current asset and net increase in current liability. You will be getting one total. With that you have to deduct net increase in current assets and net decrease in current liability to obtain the cash generated from operations. And at last you should deduct income tax paid, that is net of tax refund received should be deducted. And again you will be continuing with the next slide of less add or deduct extraordinary items. So if you have any extraordinary items which has to be added or deducted should be done here. And after that you will be having net cash from operating activities. Again you will be having certain items like cash flow from investing activities. This should be shown here, that is you will be adding this, and after that you will be deducting purchase of fixed asset, purchase of investment, purchase of tangible assets like goodwill or extraordinary items. And the third one will be cash flow from financial activities. Proceeds from issue of shares and debentures and proceeds from other long-term borrowings will be shown here. With that, you will be deducting final dividend paid, interim dividend, interest on debentures, repayments of loan, etc. will be deducted. And you will be getting net cash from financial activities. And at last you will be writing as net increase or decrease in cash or cash equivalent. So you will be adding all the three columns, that is first one, second one, third one, and then you will be adding cash and cash equivalent in the beginning of the year, that is cash in hand plus cash at bank, and plus short term deposits plus marketable securities will be added to get the cash and cash equivalent at the end of the year. With this, the introduction part will has been over. In the next video I will cover the problem relating to cash flow statement. Thank you.